Hello, I hope you are doing well this Thursday and keeping kind of a calm head through a lot of noise, a lot of news going on here the past week or so. We have some really important data to break apart here this week ahead of the Fed decision coming up just next week, not even a week from today. But our conversation, we're going to go a little different route here. We're going to spend a lot of time talking about the Silicon Valley Bank collapse and some of the things that we're watching around that, but also how that relates to the Fed decision coming up just next week. So a little special edition of our weekly update here this Thursday. Certainly want to touch on some of the important data points that have come out over the last week. But again, most of our time today is going to be really based around the Silicon Valley Bank news and kind of give you some of our perspective on what we're watching here. Before I jump into the heart of the conversation, I do want to touch on some data points. So just last week, we had employment reports come out on Friday, and we had a really strong number. Jobs added were 311,000 for the month, so really good sign there. Of course, we're in this market of good news is bad news, but also Friday is where the Silicon Valley Bank news really picked up a lot of steam. So we'll come back to that, but I did want to touch on the jobs number last Friday. In addition to that, we had CPI data come out on Tuesday, and basically CPI was in line with expectations. Core CPI just slightly higher than expectations. So, we're still seeing some inflationary pressures, no question about it, and kind of bringing down the year over year numbers slightly. So 6% on CPI, 5.5% on core for the year over year. And markets loved this at first. And then, of course, again, more concerns came out. Now, outside of what we know about SVB, if we look at these two numbers in and of themselves, we had a large jobs number, hired a lot of people, and we had inflation still showing persistence. So obviously, typically in a normal market week without the news that we've been hearing about, this probably would have been a bad thing for the Fed in and of itself. But now we've got a new factor in all of this, which we'll talk about here in a bit, as far as how the SVB collapse and what's going on here may factor into the Fed's decision. We also had retail sales down 0.4%. And then fast forward to today, initial jobless claims came out down to 192,000. So again, another strong jobs data number here, which, again, is certainly something the Fed is watching and feels like as jobs continue to show strong signs in the labor market, they have room for increased rates. Okay, now all that said, coming up next week, we're going to spend a lot of time on the Fed decision, obviously, and the press conference to follow. But we have a huge curveball here, which we're going to address in our question of the week. We got a lot of questions recently, as you might imagine, about the Silicon Valley Bank news. And so we're really going to spend some time on not just what's going on and what we're watching with Silicon Valley Bank, but also how this relates, believe it or not, to the Fed decision. So the reason that the Fed decision is potentially skewed by what we're hearing here is we've all heard this news, or we've heard this topic, or this concept, maybe is a better word for it, of a soft landing from the Fed. In other words, they can raise rates slowly, stop that rate raising program and not feel the effects in the economy. Well, I will share that, SVB is a perfect example of the fact that that's not possible at this point. I think it's very clear to say this idea of a soft landing is entirely out the window now. And SVB is the first sign of that, right? The reason for this, and maybe I'll introduce this, that we'll come back to SVB and then finish up talking a little bit about the Fed as well. The reason for this is that when the rate has risen 400 basis points, 4% in just about a year, that has a lot of impacts. Now, none of these impacts are felt the day we raise rates. It takes time for these impacts to carry through to the economy. Just like, I've kind of shared this before, just like going back to when we shut off the economy for COVID and then turned it back on, right? The supply chain issues are still being felt for that switch. Now, the same applies with raising rates, right? When we raise rates 400 basis points, or let's just say even the first 75 basis points that we did a long ways back, we don't actually feel those results in the economy for months or possibly even longer because there's a little bit of a delayed fuse here. So this is the challenge, and again, I think SVB is kind of a symptom of the challenge, or a signal that that these things can have impacts, because we didn't see anything for a long time until now. The consumer's been strong. For the most part, things have slowed a little bit, but for the most part, we haven't really seen any significant drops in anything. But now here we are and seeing some impacts of these rising rates and what it has done to, a pretty sizable bank, right? So let's back up a little bit. Let's talk a little about SVB specifically. So going back to last week, the rumblings were starting to begin kind of, I think, mid last week, early last week or so. And as the week continued on, obviously on Friday was where the brunt of all this kind of came to be. Obviously, that's when we found out SVB, Silicon Valley Bank, was collapsing. And over the weekend, there was a lot of work done. So the Fed has decided to step in. Basically, there is going to be an emergency lending program, and there's going to be a lot of help for a lot of the depositors, which is great to see. But where did this all start, right? So if we look at Silicon Valley Bank specifically, I think there's two factors at work here. Number one is obviously they were lending to and financing, and you name it, for a lot of these very high-flying tech companies in Silicon Valley. Now, that has worked out very well for them the last couple of years, but obviously you fast forward to a situation in the market where interest rates are higher, the economy is a little tighter, money is tighter, and things get a little more tricky, right? If we're offering these risky financing options or financing to risky companies, well, there can be some challenges with that as well. And none of that had been recognized until we moved into this newer regime, which of course, has some complications for those making more risky loans. Now, what I will share is that this is similar to what we've been talking about from the the market perspective. We've been talking a lot about value type of companies and watching some of these high-flying growth companies that really didn't have a lot of profits, earnings, value to be had in the first place. This is exactly why, right? This is the shift in the economic cycle, and this is one example of it. Part two for SVB is that they had a lot of longer duration bonds. So actually similar to our market approach on the growth versus value side of it, we've also helped our clients really reduce the duration in our bond portfolios as interest rates were rising. Because, although this may sound weird, when interest rates rise, bond prices do fall. And if you've kind of paid attention to our show weekly, you kind of have heard us talk about this a lot over the last year or so. But basically, when we're in a period where the Fed is raising rates, well, the prices of those bonds that are being held for longer maturities actually drop quite a bit. So that's why there was a big challenge for a lot of folks who thought they were a little more conservative last year than maybe their portfolio would show. The same happened with Silicon Valley Bank. So they had a lot of long duration bonds, which if held to maturity are fine, but the challenge is they ran into some other cash flow issues. And obviously to sell at these giant discounts were a big challenge for them. So this is a big issue. And basically the reason I'm sharing this is this comes back to why the Fed may feel they have a role in this and why this might affect their decision moving forward. The Fed had kept rates artificially low for, in my view, way too long. And what that does, number one, is it sparks more investment in more risky assets, right? So if you think about 2021, 2020, we saw, except obviously the early part of 2020 with COVID, we saw a lot of these high-flying tech companies just take off. We saw a lot of people investing in long duration bonds because it was risk-free. You've heard that term before, quote unquote. Please keep that in mind. So what happens when rates are kept artificially low is not just investors, but banks, companies, you name it, will start to invest in a way that maybe they would not typically, right? When there's a lot of opportunity out there and money is cheap, that's where we can see some challenges. And that all works okay until the flip switches and we're, in a more tight economic environment, which of course we find ourselves in today. Now, not just when rates are low does this create that challenge, but as the Fed raised rates so quickly to play a little bit of catch up, what happens is those bonds, again, the prices of those bonds drop significantly. So in this case, this bank's assets dropped significantly, and that made it difficult for them to pay off their lenders. Now, I think that there's certainly some challenges with the Fed's program around this, but obviously this comes to mismanagement as well. giving risky loans and buying risky assets could be obviously a little bit of a recipe for disaster if things don't go perfectly. And that's what we saw here. Now, coming up, we have the Fed's discussion next Wednesday, Fed Powell's conference. So the question is, well, how does this affect the Fed? I believe, without having the crystal ball, that is likely the Fed will still raise rates 25 basis points in that. But just a week ago, there was a lot of talk about them doing 50. And I think that what they will do is possibly we might hear a bit more reluctance in their voice, and maybe even a sign that they may be pausing. Because although we talk about the two mandates of the Fed being employment and being inflation, first and foremost, above all of that is price stability and market stability in our economy. So obviously, this is a sign that there's some challenges with that. And, the Fed may look at themselves and say, well, maybe we raised rates too quick. Maybe this was, partially induced by our policy, and maybe decide to take a little bit of a beat, see what happens for a bit before they continue down this path. So you have heard me time and time again say the Fed is going to do what they say they're going to do. They're going to keep raising rates as they've said. This is the first time I've kind of suggested that it's possible that they actually put a pause on things a little sooner than expected. We will see next week, but that is very much a possibility at this point because of the direct impacts to what we've seen with Silicon Valley Bank here. What does that all mean for what is ahead? So maybe to wrap this all into a nutshell here, obviously there are some challenges. Now we are seeing the economic challenges of a tighter economy. Okay, this is the first sign of it. I don't necessarily believe at this stage that we are going to see any ripple effects. Obviously, Credit Suisse is more in the headlines now, and the Switzerland Central Bank has said that they would provide some support if necessary. But I don't necessarily feel at this stage, anyways, that this is going to be something that ripples out too much further. I don't think that there's, a huge impact to other banks at this point. We'll continue to keep a very close eye on it, but I think that other banks may be managed a little more conservatively, which is obviously really important. As we look ahead, though, assuming that's the case, right? Assuming that there is not a larger issue at hand here, and assuming the Fed actually does pause a little bit ahead of time, as weird as this may sound with everything going on in the market right now, this could actually be a catalyst for opportunity. We've been talking over and over and over again about watching the Fed and their rate policy, and as soon as they maybe lift their foot off the gas, that could be where we start to see markets pick up a little bit more sustainably. Well, here we are, right? And we've seen a significant drop since the highs not too long ago, this year anyways, the highs of 2023, a significant drop from there. And if we see that the Fed actually does pause and that this is not a bigger issue than SVB specifically, again, this could be a little bit of a catalyst for the markets to start their way towards a recovery. I would be very cautious of taking that, too much to heart, but certainly watching that closely and starting to think about what this means in the long run is going to be really important. And we will watch very closely for the Fed discussion next week. We'll make sure to update you on what we hear out of the Fed on Wednesday for our next Thursday update. But in the meantime, again, we did want to switch gears here a little bit, talk a lot about this SVB news story. Again, kind of share our perspective as far as where we think that may go from here. And again, right now, we're not seeing it being as much of a broader issue yet. We're going to continue to watch it very closely, but we do think that it likely will have some impact on the Fed's decision ahead. Maybe not this specific meeting coming up on Wednesday, but certainly as they look ahead further and voice kind of their projections on what they may do in the rest of the months, the meetings ahead for the year. I hope that's helpful. Let us know if you have any questions. We'd be more than happy to answer them. And again, hopefully this kind of one-off weekly update really tied around SVB and the Fed's decision has been kind of eye-opening or maybe provided a little bit of outside perspective. Have a great day. We will see you next Thursday at 3 again, where we really break down the Fed decision as we get it on Wednesday.